Hello, everyone, and welcome back to the Deep Dive. How are you all doing?
Hope you're having a good week.
You know, there's this feeling that's been sort of quietly building on Wall Street, especially since the start of 2026. It's this question of, has the great rotation finally begun? This, massive shift away from tech and into defensives.
Right. Is it real or is it just noise?
Exactly. Is it real, or are we just looking at some typical post-holiday market jitters?
Yeah.
Well, we're not going to guess. We're going straight to the sources.
And we did. We went right to the institutional money flows, the structural data, and the answer is, well, it's pretty clear-cut.
Yeah.
The entire architecture of the U.S. equity market is undergoing a genuine structural transformation. That decade-long dominance of, let's call them long-duration assets.
So the big tech names. The Nasdaq 100, the QQQ.
Precisely. That dominance is seeing real, measurable decompression. It's happening now.
So this is real. It's not just noise. Okay, so if tech is finally giving up some ground, where's all that institutional money going?
Well, that's the interesting part. It's not the simple flight to safety you might expect in, a panic.
Yeah.
And that's why it's been so quiet.
Okay.
What we're actually seeing is something more like a strategic bifurcation, a splitting of the path.
Bifurcation. I like that. So what does that mean in practice?
It means capital isn't just rushing into, say, the consumer staples ETF, the XLP. Instead, it's flowing into three very specific zones.
All right, what are they?
First, a few select consumer staples, the ones with real pricing power. Second, financials, the XLF as a kind of cyclical value play. And maybe the most interesting one, industrials, the XLI.
Industrial?
Yeah, positioned as these essential infrastructure providers. So this is a surgical move. It's a reallocation, not a stampede.
Okay, strategic bifurcation.
Yeah.
But a shift this big needs a catalyst. What's the core macro reason that's pushing investors out of that high growth story here in early January?
At the end of the day, it's all being driven by the cost of capital, the price of money.
Right.
We've seen the U.S. 10-year Treasury yield, the U.S. 10Y, close in a really critical range. It's holding firm right between 4.15% and 4.18%.
And that's not just a random number.
Not at all. That yield range is acting like a fundamental gravity well for all asset valuations. It changes the entire equation.
So explain that for us. Why does that 4% range specifically change how investors look at high-growth tech stocks?
It all comes down to something called duration sensitivity. It's a really crucial concept for you to grasp.
Okay.
Think of those big growth stocks in the Nasdaq as long-duration assets.
Meaning their biggest profits are way out in the future.
Exactly. The bulk of their expected cash flows, you're looking at 5, 7, maybe 10 years down the road. But when you can get a guaranteed, risk-free 4% return on a treasury bond today,
It makes those future profits look a lot less attractive.
it shrinks their present value dramatically. The math just starts to break down for these mega caps that trade at, these astronomical multiples.
Oh, the risk-reward just isn't there anymore.
Precisely. A stable 4% interest rate basically kills the argument for paying a price-to-earnings multiple over, say, 30x for these companies, especially when their earnings growth is already starting to slow down.
Which brings us to the other side of the coin. Those stable rates suddenly make defensive stock dividends look pretty good again, right?
They look very competitive compared to risk-free assets. And you mentioned safety. Our sources are highlighting a real psychological shift in the market, a new focus on what they're calling fortress balance sheets.
And what's driving that?
I mean, you have to look at the recent political context. We just came out of that huge government shutdown back in November 2025.
The longest one in history.
Right. And that kind of thing raises the risk premium for the whole market. So institutions are now actively hunting for companies that have, let's call it, macroeconomic independence.
Oh, companies whose sales don't depend on whether Congress can pass a budget.
That's the key. They want companies with inelastic demand. The demand for, a tube of toothpaste from Procter & Gamble or groceries from Walmart.
It's not going anywhere.
It's not reliant on government budgets or subsidies. And in this uncertain climate, that certainty of demand makes these companies a safe place to park capital.
All right, let's dig into the hard evidence, the forensics. If this rotation is for real, we should see it in the cash movements. What are the flows out of tech actually telling us?
They're telling us that the smart money is already quietly leaving the party. Just look at the figures for the Invesco QQQ Trust.
The QQ.
It's the clearest sign of institutional distribution of selling that we've seen in months.
So give us the numbers. How bad is it?
In just one session, a single day in January, the QQQ saw a net outflow of a staggering negative $2.21 billion.
Wow, 2.2 billion.
And that wasn't a one-off event. This trend has been accelerating. In November of last year, it lost around 906 million assets. So the selling is picking up speed.
That is a massive amount of money leaving. But here's the confusing part. The index itself is still trading near its all-time highs.
Right.
How do you square those two things?
And that is the absolute crucial observation. That's the whole point.
Okay.
These huge outflows are happening while the price is still high. That is the textbook definition of a classic bearish distribution divergence.
The smart money is getting out.
The institutional money, the so-called smart money, is methodically exiting their positions. They're selling into whatever buying is left, maybe from retail or systematic funds.
So the foundation is being pulled out from under the index.
It's incredibly vulnerable. That bedrock of institutional support is just being removed piece by piece.
So technically the structure is weakening. What does the technical diagnosis of the QQQ look like right now?
We're seeing clear signs of exhaustion, especially in what we call market breadth.
So how many stocks are actually participating in the rally?
Exactly. And for the Nasdaq 100, only 59.80% of stocks are trading above their 200-day moving average.
That doesn't sound great.
It's not. It's narrower than both the S&P 500 and the Russell 2000. It confirms the whole rally is depending on just a handful of those mega cap names. It's very precarious.
And if we look at the chart, you can just see the price hitting a wall.
Absolutely. The QQQ has run into what our analysts are calling a concrete ceiling. It keeps failing to break through that band between $629 and $633.
That's just stuck.
That resistance shows that the buyers who are left just don't have the capital or maybe the conviction to push it any higher.
So what's the key level, the line in the sand that investors need to be watching right now?
You need to have a laser focus on $620.
$620.
A decisive break below that level, especially on heavy volume, would confirm this whole distribution structure is real, and it would signal that this rotation is about to accelerate.
Okay, let's pause here for a second. If you're finding this deep dive valuable and you like what you're hearing today, we'd love it if you'd subscribe, maybe leave a like, and let us know in the comments what you want us to tackle next.
And just a quick reminder, you can find the link to PayPal in the description below. Any contribution you make helps us keep producing this content. We only ask for the cost of a coffee. Thanks so much for all your support. All right, now let's get back to where that money is going, because this is where the story gets a little tricky.
Right.
If this is a flight to defensives, why on earth did the main consumer staples ETF, the XLP, actually see outflows? It lost over $184 million in a recent week. That seems like a contradiction.
Yeah, that definitely complicates the simple rotation to defensives headline.
It really does, but it confirms that strategic bifurcation idea we talked about earlier.
Yep.
The big money isn't buying the whole index. They're operating in what we'd call a sniper's market.
A sniper's market, meaning they're picking and choosing.
Yeah, exactly. They're selling the broad XLP index, which holds some structural losers, certain old school food companies or tobacco stocks. And they're immediately putting that cash into very specific, high quality defensive names.
Okay, so let's name names. Who are the winners? Where is that quality bid landing? You have to start with the big retailers, I assume.
Oh, absolutely. Costco, or Cote, is really the gold standard here.
Yeah.
They reported $30 billion in net sales just for December 2025. I mean, that just defies any kind of slowdown narrative.
And it's that membership model, right? That recurring revenue.
That's the magic. It functions almost like a software as a service, a SaaS subscription, but it's anchored in the real world. That predictability is worth a huge premium right now.
And then you have Walmart, WMT, which benefits from that classic trade-down effect.
Right. When things get tight, even higher income shoppers start looking for value at Walmart. And our sources point out something interesting. They say Walmart is a stock that hedge funds just hate to short.
Really?
The short interest is tiny, only 0.59%. That tells you how safe the street thinks that name is. There's a perceived floor under the stock.
Okay, so beyond retail, what about those classic bond proxies, the old school stable stocks?
They're definitely getting a look. Think about Coca-Cola, KO. It is a stability anchor. It has an ultra-low beta of just 0.13.
So it barely moves when the market gets choppy.
Exactly. And then you have PepsiCo, PEP, which is an interesting hybrid. It pairs that defensive stability with some really cutting-edge tech adoption.
Oh, yeah.
It does. Pepsi is working with NVIDIA, of all companies, to create digital twins of its factories to optimize them. So it shows that defensive doesn't have to mean stagnant.
And Procter & Gamble.
PG.
The classic dividend aristocrat. The yield is nearing 2.9%. And get this, a discounted cash flow analysis from one of our sources suggests PG could be as much as 26% undervalued. That's a huge margin of safety.
But even with these great names, you said that traditional defensives weren't the number one destination. You mentioned a third way that's getting the biggest inflows. So where is the bulk of the money actually going?
So we see two sectors that are just sucking up the majority of these inflows. Number one, healthcare. XLV.
It captured the largest inflow of all, over $1.1 billion in just 1 week. And it makes sense. Healthcare gives you that same inelastic demand as staples, but with much better margins and real innovation catalysts.
Okay, so healthcare is number one, and what was number two?
Number two was industrials, XLI. It pulled in over $900 million.
Well, that seems strange. Why are funds rushing into industrials if they're worried about economic growth? Isn't that counterintuitive?
It would be, but the entire thesis for industrials has changed. It's not cyclical anymore, it's secular.
How so?
They are now the direct beneficiaries of two massive spending megatrends. First, all the infrastructure needed for AI data centers, the power, the cooling, the buildings.
Right, the physical stuff.
And second, the ongoing reshoring of supply chains back to the U.S. These sectors offer real, tangible growth, but at much more reasonable valuations than tech.
So let's talk more about those two value sectors, financials and industrials. The financials ETF, XLF, saw almost $700 million in inflows. What's the thesis there?
For banks, it's what analysts are calling a Goldilocks environment.
Not too hot, not too cold.
Exactly. Interest rates are high enough, that stable 4% we talked about, to support really healthy net interest margins, or NIMs.
So they're making good money on loans.
Great money. But crucially, the economy is still strong enough to prevent a wave of defaults that would wipe out those profits. So when a solid bank like JPM pulls back a little after earnings, you see analysts immediately call it a buy-the-dip opportunity.
And then industrials. You mentioned Caterpillar, CIT, and linked it directly to the AI boom. This is where the digital world meets the physical world.
That's it, exactly. The market is completely revaluing a company like SIA. They're not just selling tractors for road construction anymore.
Right.
They are selling the essential equipment needed to build the massive energy infrastructure and the physical data centers that the entire AI sector depends on to grow.
And I imagine the numbers back that up.
They do. SIA just raised their price target on CIT all the way to $710, citing this new structural demand. And maybe more importantly, SIA has a record backlog of orders approaching $40 billion.
$40 billion.
That's a level of revenue visibility that tech companies can only dream of. And it's a huge draw for institutional money that's looking to de-risk.
Okay, so before we wrap this up, let's take the market's temperature. Is this rotation happening out of panic, or is it more orderly? What do volatility and sentiment tell us?
All the signs point to an orderly strategic shift. This is not a forced collapse.
Okay.
The VIX, the volatility index, is pretty tame. It's hovering between about 15.9 and 16.6. That tells us investors are buying some protection, sure, but they're not panic selling. There's no fire sale.
And what about the fear and greed index?
It's sitting right at 51, dead neutral. The market is balanced, and that balance is what's allowing this rotation to happen in an orderly way without, a huge destructive crash in the tech sector.
So let's bring this all together for you.
Yeah.
The key takeaway from this whole deep dive is pretty clear. The great rotation is real, it's happening, but it's very, very nuanced.
Right. The risk-reward in tech, specifically the QQQ, has gotten a lot worse because of those huge institutional outflows and that dangerously narrow market breadth.
So the strategy is really about targeted diversification.
It is. The roadmap from our sources says you should be buying specific quality defensives like Costco and Walmart, structural growers in healthcare through XLV, and that cyclical value in industrials like CAT.
And the tactical play is very clear. You should be underweighting the QQQ, especially as it gets near or above that $630 resistance level.
And then you use that liquidity, that cash, to overweight a diversified basket. Quality defensives, value industrials, and structural health. The goal is resilience, but paired with real, tangible growth.
And here's the final thought we want to leave you with. This rotation, when you really get down to it, it isn't a movement away from technology's impact.
That's a great point.
It's actually a rotation into the picks and shovels that are required to build and sustain that digital future. The energy, the physical plants, the infrastructure. The ultimate safe haven, based on this data, might not be the company promising some far-off technological future, but the company that is literally building the foundation for it today.
That is a powerful paradigm shift to consider. as you look at your own portfolio.
And with that, we've reached the end of today's deep dive. We really hope you enjoyed it, learned something new, and that you'll join us next time. Thank you so much, and we'll see you again very soon.
Remember that in the description of this video, you'll find the PayPal link if you want to support us. Thanks again for listening.